as we reviewed last year, market returns have been attributed to just a few companies, many of which are direct suppliers of or beneficiaries to this artificial intelligence trend. But this year, with the recent changes in investor sentiment around corporations spending on artificial intelligence that I discussed, as well as the gradual change in economic activity that John just touched on, we've witnessed a shift away from a rally in a few concentrated stocks to a more broad-based market rally. And this chart here exemplifies this shift. Here we're comparing the relative performance of the S&P 500 market-weighted index to that of the S&P 500 equal-weighted index. Now, the takeaway for this chart is that when the line goes down, there's generally less concentration and more breadth in market advancements. As you can see, the line was moving up all of last year, while this year we've seen the line moving down. It's important to point out that both years have seen solid stock market returns, but the driver of market returns in 2024 has been less reliant on just a few concentrated stocks.
What is driving this change toward a broader market rally?
There are three key market changes that we've been monitoring that are driving this shift to a broader market. The first being an increase in number of companies expected to grow their earnings. The second being better earnings growth for the broader market relative to the more concentrated Magnificent Seven stocks. And the third being the change in interest rate policy. First, there are more companies expected to grow their earnings compared to this time last year. And this chart shows the percentage of companies in the S&P 500 with a positive 12-month change in expected future earnings. Now, we recognize that this is a bit of a busy chart, so we want to focus your attention to the portion of the blue line that we've circled, which shows that the percentage of companies growing their earnings has increased significantly, up from about 55% of companies in 2023 to around 75% at current levels. The second reason for more market breadth is that earnings growth expectations for the broader market have improved in absolute terms, and the earnings growth expectations for the Magnificent Seven stocks have come back down to earth. As a refresher from our conversation last year, Magnificent Seven is the nickname created to group the companies Apple, Amazon, Alphabet, Meta, NVIDIA, and Tesla. As you can see from this chart, there was a massive earnings growth gap between the Magnificent Seven and the broader market in 2024. In 2025, the expectation is for this gap to narrow significantly. The third reason for more market breadth is due to change in interest rate policy that John discussed earlier. As the Federal Reserve changes its process of reducing short-term interest rates, moving to a more accommodative interest rate policy, we also see an impact on an equity investor appetite and expectations. So this next chart compares the average equity sector performance 6 months after the Federal Reserve's first interest rate cut during the last 4 cycles. Utilities, consumer staples, and healthcare sectors are historically have been categorized as having defensive characteristics. And as you can see, in the last 4 Federal Reserve policy cycles, they were the 3 best performing sectors 6 months after that first interest rate cut. For comparison, these sectors were 3 of the 4 worst performing sectors in 2023 when we experienced a more concentrated market. Now, it's important to point out that no 2 cycles are the same. And in fact, the last 4 cycles were in response to very large economic events, which is in stark contrast to today.
So, Justin, with these market dynamics continuing to evolve, how do investors maintain a grounded perspective?
Well, we've been fortunate to have a few consecutive calendar years of excellent stock market returns. Just this year alone, we've witnessed more than 50 record closes for the S&P 500. And while we are certainly grateful, we are not complacent. We recognize that this environment is a perfect reminder of the importance of reviewing our client investment allocations and, where appropriate, rebalancing both our equity and fixed income portfolios. Allocations and inherent portfolio risks will have shifted in set it and forget it and non-professionally managed portfolios. For example, a 50% stock and a 50% bond portfolio at the beginning of 2023 would look closer to a 58% stock, 42% bond portfolio as of September 30th of this year. Now, for some clients, this may be an acceptable or even welcome change, but in that case, it's prudent for us to update our investment policy statements to reflect this increase in risk tolerance. For others, it's been a great opportunity to take market gains off the table and rebalance to more appropriate long-term allocation targets.
So Justin, it's important that we're proactive when markets are really strong to rebalance along the way, to really go back to that asset allocation and make sure that we're not becoming complacent on it ahead of stock market volatility, right? So what would history tell us is normal to expect for stock market volatility, which we know is inevitable at some point?
Yeah, what we do know is that short-term volatility is kind of the price of admission for long-term growth. And while unpleasant, market swoons are an inevitable part of the investment landscape. As you can see from this chart, historically, we've experienced a 5% decline multiple times a year, a 10% decline once a year, and a full-blown bear market 20% decline or greater every 3 or 4 years. And as investment managers, we recognize the follies of attempting to predict the unpredictable, like when the next correction or bear market may occur. Instead, we choose to prepare for the inevitable. The great investor Peter Lynch once said that far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves.
So Justin, when we hit these inevitable bumps in the road, it is often natural for investors to say, hey, it's been a good run. There's a lot of uncertainty out there in the world today. Let me just sit this one out until things calm down a little bit. What risk is there to this short-term strategy?
It's a natural emotional reaction to want to sell out of the market, seeking safety in cash or other assets during extreme market declines. But the reality is that the result of doing this can be devastating to wealth creation and the goals and desired outcomes set forth in financial plans. This chart serves as a reminder and the forewarning of the risks of market timing. Using roughly the last 20 years as a guide, investors who miss just the best 10 market days during that 20-year period see their annualized returns nearly cut in half. It's also interesting to note that many of those 10 best days occurred within just 2 weeks of the 10 worst days, meaning by attempting to miss the worst days, you're often likely to miss the best days as well. Just another example of the impossible nature of timing the market. We are firm believers that the only surefire way to lose out during periods of poor performance is to capitulate, selling assets at depressed values due to improper planning or fear. Investors who are educated on and prepared for the inevitability of volatility are better emotionally equipped and better able to take advantage of the opportunities that these market swoons create to purchase quality companies at discount prices. Long-term investors are rewarded for their ability to withstand the discomfort and trusting in the safeguards embedded in their portfolio constructions and financial plans and benefit from the effects of long-term compounding.